Hi, everybody. Just want to make sure you can all see my screen out there. Hello from PA. Hello, PA. Greetings. Yes, 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 yes. Beautiful. All right. So everybody can see my screen. It is Wednesday midday. Normally, this would be the exact middle of the week, but it's not because we had Labor Day on Monday. And it looks to me like what you got going on is pretty much what we've been talking about, is this idea of being in a chop zone. You have this sharp break off the peak. NASDAQ rallies right into resistance. And I know we've gone over this many times before, but for those who are new, um, just go over this, what we've been talking about the last few days, or at least last week, because last week we were right at this point, and as I said back then, that was pretty much where you can try getting short. We went along the SQQQ on a sell signal in the model based on the action of the leaders, which were all coming up to their either 50-day moving averages, 200-day moving average, or coming up to an area of prior resistance. So from that perspective, you have the leaders converging with the NASDAQ moving into the 2600 level here, which, as you can see, coincides with these two bottoms. Therefore, former support turns into resistance. And of course, now you see we have the sharp break, and now we spent about the last month going back and forth in the chop zone. And we can go short here, and we think that's pretty low, lowest trader. It was last week when we did it, when we put it on, because your stop is simply the high of this day right here is 2611. You could put in a trailing stop at this point, but we're going to run the model as purists here, take the position, and if we're stopped out, we're stopped out. Otherwise, we're sitting with it, because you could emerge from this chop zone here and break to new lows, and that's kind of what we're looking at. After you come down 3 days yesterday, very hard off the peak here, and really 1, 2, 3. If you look at this as a reversal day, I kind of saw that as distribution, and it was churning on heavier volume here. Then you come down 1, 2, 3 days, and then on Monday you gap down on news, and here you are gapping back up. So it just shows you how volatile the situation is in here. So you really have to be steady in terms of identifying the trend and not getting wigged out of your positions. If you are owning the SQQQ, the TZA, or the QUID, or whatever it is you're into as your inverse ETF on the sell signal for the market direction model. Dr. K, what is your take on the model? How are you handling it, and how do you think members should be handling it at this point?
Well, yeah, I think you already said it best. Pretty much, we're in a chop zone, so the model aims to capture intermediate-term trends, meaning it's not going to attempt to finesse the day-to-day wiggles of the market. And because we're in a chop zone, there is going to be a lot of wiggling going on. So ultimately, the model seeks to capitalize on bigger gains rather than day-to-day gains. It right now still believes that we are going to retest these lows that were hit in August without hitting the well, there is a failsafe up around that prior peak on the Nasdaq at 2612. That's not a guaranteed failsafe. The failsafe can be adjusted, but right now that's kind of where that is where the failsafe has been placed. It could move higher though, depending on the action of general indices and leading stocks.
So what would cause the model to go back to a cash signal?
It has to hit that failsafe, or before that failsafe is hit, I would need to see constructive action in a number of leading stocks to push the model into a cash, or even potentially a buy signal if we did get a follow-through day accompanied by constructive action.
Gotcha. Here's a quick question related to the model. What stop would you use for a 3x ETF, 3 times leverage ETF here?
Well,
would you use a 65-day EMA? And I would say right off the bat, no.
Yeah, I mean, the stops are entirely subjective to a person's risk tolerance levels. So if you get into a position late, for instance, you're 6% late, that's 6% added risk that you're going to have to take on. Now, maybe that's acceptable to some, but not acceptable to others. So everyone should always have their sell stops in place if they're not using them, if they're not relying purely on the model. Now, some members do rely purely on the model's change in signals, knowing that it does have fail-safes built in, and they do their best to get in right when the model switches signals. Maybe sometimes they're a little. Sometimes you get a better price actually if the market has a little mini gap down the next day, so then they can get in at a cheaper price. And contrarily, some might pay up maybe 1%, but that's usually within people's risk tolerance levels.
So let's say if you miss the signal here, and this is when we put out the sell signal, you can go back and check the archived market direction model reports for those of you who are asking when the sell signal occurred. But let's say if you miss that and it's pulling in, would you consider this a potential entry point as the market rallies up using the same stop?
Well, again, if that stop is within a manageable percent loss for the investor, then that's fine. Every investor always has to calculate, okay, where is their sell stop and what percentage loss is that? If, for instance, their maximum tolerance is minus 8%, then they should not exceed that. Alternatively, let's say it's minus 10% where they'd like to get in, they could go in with a smaller position size. Because ultimately, it's all about what your account is going to do relative to the trade you're putting on. How much is your account going to potentially gain, and how much is it going to potentially lose? And every investor actually should do that with every single trade that they put on, and they should always know their sell stop, and they should also take the aggregate of every position they have in the portfolio and understand a worst case scenario. In other words, if every single sell stop were triggered, how far down would their account be, and is that a loss that they are able to take without it creating any psychological problems or losing sleep?
Right. So basically, everybody's got to figure out their own stops, taking into account how much they're willing to draw down if they get stopped out on every position they have, or even if it is a 3x ETF. So, I do find a lot of questions. I think it's very normal for investors, especially newer investors. They want to put everything into black and white. Everybody wants a hard answer. Everybody thinks that the market can be handled in terms of black and white. And everything is kind of relative, and you're just managing risk on these. So any position you take in a 3 times ETF, you really got to figure out, okay, if the market does this, I'm out at this point, and that's kind of what you're doing. So right now, just to tell you how we're operating, we're pretty much using this this day here, which would be send us down to a 23.31. No, let's see, 23.18 low on the skew. We might get out sooner. But at this point, that would pretty much do it for us, and our loss would be very tolerable in that case. Of course, we're up pretty nicely for the year, so we have cushion to operate with. Somebody who maybe doesn't have any kind of cushion to operate with and isn't in the mood to lose any more money if you've been losing money all year long. And there are a lot of people who have, I'll tell you that much for sure, and I know a lot of O'Neill followers or O'Neill-style managers we know are having a lot of trouble this year as well, but I think it's understandable because it's very choppy, it's very difficult, and you really can see that in terms of the market since the beginning of the year. Here's January, it's really just been a big chop and slop maneuver, and that's really all you've had. So we can kind of blow this up a little bit. Everybody see that okay? Yeah, okay. But you can see, it's just kind of choppy. This is what you might call a rolling top. So we operate on the basis right now that the market's in a downtrend. You could rally up to the 50-day. By the time it gets there, you could be close to 2,600. That's within the realm of possibilities. But my guess is that what you're looking at here is a period of consolidation based on this breakdown. So you're basically consolidating the prior breakdown. And, you might see this as a move up, reverse it, or flip it over, and this could be a big move up, and this is like a reverse flag. And you notice it is pulling up in a reverse flag, whereas pulling down with volume drawing up would be constructive. In this case, you're pulling up with volume drawing up in the general pattern. So that's kind of what you're seeing right now. So the way we operate is staying along the SQQQ, where we took the position down here. I think we add a little bit in here as well, but we're doing okay with that position overall. And we could get stopped out, but that's how we're going to operate. Our feeling is even if you did go sideways for a period of time, you're eventually going to resolve to the downside. We don't see a lot of constructive action in the leading stocks. For instance, you do see things like Priceline trying to come up. Let me actually switch charts here. This is the wrong volume. Here we go. You can actually see the Priceline trying to come right back up. So I don't know if you call that constructive. It's pretty volatile, so not really tightening up. And if you're looking on the weekly chart, maybe you're getting a little tighter in here, and you could tighten up. So that's a possibility, and maybe that's one to keep an eye on. But these are leaders that have had a big move, and they're pretty obvious. And you got Amazon straight down, straight up. I'm not going to buy this thing here. In fact, I might be concerned that it could break down here. But really, all of these, you can't tell what they're going to do from here, but they're not constructive enough to buy. Dr. K, you see anything constructive enough to buy if, in fact, you wanted to start going long stocks?
Not in this kind of environment. Not today. Things can change very quickly, but if you're looking at leading stocks to buy, I don't see anything right now. I do see names I'm keeping an eye on though, and that Priceline would be one of them. Hands would be another one. HANS.
Priceline, Hands.
Amazon, ANGN. That had a pocket pivot yesterday, as we know, but it wasn't worth putting a report out on just because the odds.
Little V shape.
Yeah, the odds don't favor this kind of pocket pivot working, especially in this environment. Maybe if we were in a more friendly environment, it might be a little different. But right now, there aren't any leading stocks that are acting the way I'd like to see them act.
Right. You had a continuation pocket pivot along the 10-day moving average on AutoZone yesterday. I thought that was kind of interesting.
Yeah.
But would I be buying it up here? I don't know. If you did buy yesterday, you're up on it today. But that's the kind of thing you're seeing. It's kind of specific to a few stocks. Meanwhile, you see a lot of things, and I've been watching a few things this morning. Like you look at these stocks like Rackspace. They're looking like the market is sort of chopping and slop. So you're kind of in this zone here. On a candlestick, this might look a little bit like a doji. We'll see how it finishes up the day. But really light volume and gapping up within this sort of pattern. I think it's going to resolve to the downside. I don't know if it rallies to the 200-day beforehand. Some of these I might be willing to test with positions on the short side and tight stops to see if they do give way here. But right now the market has a pretext for rallying, and that is specifically Obama's big job speech tomorrow, where he's going to lay some brilliant idea on us that's going to fix everything. I think there's not going to be any real solution coming from him, even if he tries to do something like $1 trillion infrastructure stimulus. I don't think that would pass the House, for one thing. If it did, it might spark a rally in stocks because all you're getting is more money printing. But again, that would bring us back to the gold and the silver. And so, just to cover these, our view right now is these are fine. They're just doing what they need to do right now. Everybody sees a double top. Everybody acts on the double top. But it seems like right now the GLD is holding support at the 20-day. And it's a little bit interesting to note that the GLD and the SLV, as far as their moving averages go, they seem to have switched roles. Because last year, if you bought the breakout in silver up through the 1920 level, SLV pulled back here, and the green line is my 20-day moving average. Okay, so it pulls back into the 20-day moving average, runs up, pulls back again into the 20-day moving average, runs up again, pulls back. Then when it violates, you can sell it, and then wait for it to set up again and break out and buy back here. And again, it follows the 20-day moving average until it goes into this climax move. So last year and the beginning of this year, SLV was following the 20-day moving average. Now what it seems to be doing is using the 50-day moving average, which is this blue moving average right here. And you notice you got this nice little uptrend line. You bounced off of trend line support today. So this is fine. It's just working off some of the overhead from this move, as well as a 68% increase in margin rates on the silver contracts on the various commodities exchanges where silver is traded. And so that puts a damper on it. The same thing happened with gold last week or the week before last, and you undercut this level here. You held the 20-day moving average, so you're holding the 20-day now. We don't necessarily think you have to use the 20-day as a selling guide. You could, I suppose, but that might shake you out. Of course, on the other hand, it wouldn't surprise us to see gold move back and forth for a period of time. That might be normal, but we think the fact that it's able to recover. Now, my view personally, and I'll get Dr. K's opinion on this in a second, but I think the fact that the CME is raising margin requirements, I think that's constructive, actually. For those of you who might have caught me on Fox, I think week before last or last week, I forget, I told Stewart that, he says a lot of their viewers were mad about the CME raising margin requirements. Of course, my quick response to anything like that is that anger is not an investment strategy, so I really don't go there. There's not anything to get mad about. They raise the margin requirements. Hot money flies out of the GLD or out of gold and pulls down the GLD. So the hot money gets pushed out. And I think, when you're running positions and things where you have 10% margin, let's see here, where was I? When you're running 10% margin on things, it's going to be volatile. So I think you get the hot money out of there, and I think that's pretty constructive longer term. And I do think a lot of so-called normal investors, or people who wouldn't be commodities traders necessarily, I think they're looking at taking positions in gold and silver one way or another, either physical or through ETFs, within their overall portfolio. So I think you're seeing a trend, a secular trend back towards some of these commodities and precious metals. And so as the investing public comes into them, I think they would have a stake in seeing less volatility, and I think overall it's probably good for the metals. In the short term, you're going to have to take some pain if you're long the things when they announce a margin increase. But my view is that longer term it creates more price stability, maybe more coherent or more orderly trading in the metals. So, we believe they're going higher. It's just a matter of how fast and exactly how far. But from here, we think gold and silver are going higher. So we tend to view pullbacks as buying opportunities. If you're oriented that way, we tend to add on strength ourselves. But either way, we think they're going higher. Dr. K, any take on any of that?
The fundamentals are in place for higher prices in gold, which has so many tailwinds, as I've written about in prior reports. I don't think I've ever seen such a confluence of positive tailwinds that argue for higher and higher gold prices. So until something material changes on a fundamental level, I'm going to be a bull on gold, and I'm also going to be a bull on silver, since silver tends to follow gold, and once it does get lock and step with gold, it tends to outperform it on the upside by a factor of 2 to 4 times. But because it is volatile, it can also drop 2 to 4 times as quickly as gold when precious metals are either having a minor correction or becoming out of favor.
Yeah, and you can see right now silver is following this little trend line here. Just look for it to bounce along. Maybe it does dip below it and catch the 50-day down here, but that's kind of how we're looking at it right now. I suppose pullbacks to the 50-day on silver, you should buy the heck out of them until it finally violates it. But for now, it looks like it's just going to move higher. You can see also you're getting these ants on silver, which tells you it's up 12 out of 15 days or better. And that's just a sign of constructive action. The way we used to use this at O'Neill is that, and again, this is for those of you who haven't heard me talk about this before, we call these ants. The .efs file, Eddie Frank Sam EFS file, is available. That's for eSignal on our website under the download section. But it basically will show these little triangles, or triangular little things here. Every time you see it up 12 out of 15 days or better. At some points when you're long in a run, it can tell you you're getting into a climactic phase. But if you're just starting to break out and you see some of these, that tends to be constructive, okay? So it's just a sign of strength. Whether it means anything in terms of you can blindly buy into it, no. You do have to do a little bit of thinking, but it does help you understand that silver is stronger than it might look on certain days. And if you look at the overall pattern of the selling on these pullbacks, look at this first wave of selling, one wave of selling on pretty heavy volume, second wave of selling here on heavy volume but less overall in aggregate than you saw over here. And now this time again we have a sharp pullback. Yesterday you closed in the upper part of the range. Today you're trading back up to the upper part of the range. Silver's only down, what, 21 cents right now, so it's coming back very fast on the futures contract right now, so you're bringing the SLV up. So it's and you're seeing less selling volume and coming up off of this trend line. So this looks okay to us. Almost looks viable right here. So that's really the story there with silver and gold. We think they're fine. You may not get make a lot of money in them and get heavily rewarded right off the bat, but that is where they're at right now. So let's see some questions here. Could we look for the Nasdaq to hit resistance at the 65-day EMA before the 50-day DMA or 20? Well, again, you're asking for some kind of hard answer. What's going to be resistance? Whatever turns out to be resistance is what is resistance. So, if you're looking at this, let me throw up a Well, let's do it over here. This has a 65-day. Obviously, if it starts rallying, it's going to get to the 65-day exponential first. So if it stops there, then yes, that would be resistance. If it stops at 2600 level, yes, that would be resistance. So it could rally to any of those. I don't know whether any one of those it has a higher probability of failure than the other one. It could just blow through all of them and go higher. There's always that potentiality. But I think you just play it on the price volume action at the time that it comes up in there. So, when we saw the market coming up into here, what was the price volume action simultaneously that you're seeing as you're seeing the NASDAQ run into 2600? Well, it's a big churning day. So there it is. Bingo. You go short right there, and so far you've been rewarded now. You're playing through the bounce. So that's pretty much the story there. Somebody says, let's see here. Let me kind of. IBD still says confirmed uptrend versus market direction model on sell. We don't pay attention to IBD. So, if you're in a confirmed uptrend and you were buying stocks last Wednesday, you probably got smacked around pretty good. So we don't really play that way. It's Dr. K's model is much more refined than what IBD does. Not that what IBD does doesn't work. It's fine for determining their overall market trend, but in terms of how we use it to trade ETFs, IBD doesn't cut it. So, and that's not to say anything bad about IBD. It's just not what we're going to pay attention to. So, the question though is IBD on a confirmed uptrend due to IBD looking at distribution days differently? Probably. We don't count distribution days the same way. Is that correct, Dr. K?
Yeah, I mean, this dates all the way back to 1989 when I read Bill's book. And I was very inspired by his claim to be able to time the market. So I created that's how the market direction model was born. It wasn't called that in those days, but 1991 was the first good year of the model. And when I actually came to work for O'Neill, I had a big stack of all the company memos dating back to 1968. So I was able to prove to myself that his method actually works. He's able to catch major trends in the markets. When he claims he's never missed a major bull or a major bear market, it's a correct statement. But that said, I also observed that model that he uses is not really a model. It's more, oftentimes it's his gut feel for a particular market. And I saw him, we both saw him get whipsawed around quite a bit during volatile or uncertain environments. So the whole inspiration behind the market direction model, because I was in graduate school in 1990 and 91, was to statistically formalize what I was reading in How to Make Money in Stocks. So in other words, all the rules that go into my model are systematic rules based on what the markets have actually done over many market cycles. And when I came to the company, I was very surprised to see that no formal study had ever been done. So this is the reason why I put full focus on my model and not anybody else's, because I know how it works. I built it from the ground up, and it's based on hard evidence of how markets have actually behaved going back not just 10 or 20 years, but over a period of many decades.
Yeah, and all we can tell you for sure is that while we were there had never really been done any formal statistical study of follow-through days until I had Dr. K do it in the efforts to get one done when someone else supposedly was working on one and it was taking them months to get it done. It took Dr. K a few hours. So I think all of that speaks to the fact that I think Dr. K's model is probably more accurate in terms of the type of trading we want to do with ETFs. Hey, Dr. K, here's a really good question for you. Even though I know the answer, I'm going to let you answer this. What trading platform does Dr. K use on his iPad?
If I need to be at the desk, I'm going to be on the desk. I use my iPhone. I use basic stock alert programs. They're stock alert apps. So I can be alerted if a certain stock or ETF or index hits a certain price point. And then I can go ahead and through my iPhone, I can actually go ahead and do what I need to do. I love the little iPhone. It fits in your pocket, and I can be quite effective. But if the market's very busy, if we're having a very busy day, I prefer to be in front of my computer in the cockpit, shall we say, because I need all the power and all the speed for getting trades on if it's one of those kinds of days.
Right. And we're just we use the night platform, so you know, that's kind of our platform. It's not available to the public, I don't believe, but it works fine. You know, it's just order entry anyways. And we're not all that specific about fills and, you know, that much slippage as long as they're not a buck or more. But, you know, if you're trying to write a trend for 50 to 100% or more, you're not worried too much about 25 cents here or there, you know. So that's really not the point. But, you know, we can afford pretty good trading systems if we want them. But right now we just use a night platform and Schwab's trading platform, which is actually not too bad. Let's see here. I'm going to go through some stocks that I'm looking at as short sale targets. Okay? Everybody want to go through that with me here? Somebody, well, I'll answer a question on this. Somebody's asking about Mercado Libre. You know, I don't know. This is looking like a lot of other stocks, so it's in this position where you've broken down and now you're going up once, twice, and here you are. You know, your low risk spot is either at the top of resistance here or at the 50-day moving average. So that's how you might handle it. You could test the position today. You know, if you take a quick stop, or you could start building a position. So, you know, I would say something like this is potentially shortable on a rally. Let me pull up, this is a weekly chart here, so let's shrink this a little bit. And I see what you're looking at here. So, you know, you have the right idea, I think, definitely. You know, you got some left shoulder as a big ugly head. You get the big break here on heavy volume, defines the right side of the head. And now you've got, see the wedging here going on, the heavy volume here, but then it starts to lighten up significantly on a weekly basis. Now, the optimal spot to hit this thing would be somewhere in here, you know, because I could see it rallying past the 50-day or the 10-week, which is the blue line here, and getting up to the 200-day moving average. But remember, you always have to interpret the patterns of short sale target stocks within the context of where the market is and what the market is doing. So, just to give you an example, last week, probably just leave this up here. Last week when we hit here, okay, so let's go back. That was 831, and that was the last time we put out a market direction model report, and I think that went to a sell signal, correct, Dr. K?
That's right.
Yeah, somebody's saying that they never saw it, and the 831 report wasn't a sell signal. So I don't know. As I'm reading it, it was. But
wait, hold on. Say that one more time.
Was the 831 report? Do we go on a sell signal there?
Hold on, I'll get the exact date.
Yeah. As I recall, we did, but, you know. No, I don't use Street Smart Pro because I can't. Otherwise, I'm going to charge me a whole bunch of money, and I can just use Night. And the other thing is, I only have, the only account I trade through Schwab is not an account that I rarely come into the market. Only when there's a very well-defined trend will I trade that account. Otherwise, I trade my own money on the Night platform. I have an institutional account with J.P. Morgan. Yeah, okay, thank you, John. John comes in and says, yes, it was. There were two emails, 831. On 831, the second was a sell signal.
Just confirmed.
Cash signal in the morning, then sell the same day. So, okay, good. Well, at least you know our email system works there. But whoever missed that, you know, you want to review that, and you do want to make sure that you don't get either the wrong signal, a late signal, or no signal at all because your emails aren't coming through. So you might want to double check on that, because we definitely don't want that happening. Because anybody who did take that sell signal, you did pretty well. And we're sitting in a decent position here to potentially make more money if the downtrend breaks and never gets above 2,600. But I want to go back to this idea when we had the sell signal. Okay, look at the NASDAQ here. Now I'm just going to do this. And this will keep, so 831, that's where RAX was. See, this has been a breakdown. This is kind of a domey type of thing. You could look at this as a failed late-stage double bottom base. And you rally right into the 200-day, the same day that the NASDAQ is doing the same exact thing. You go short right there, boom. And there were a lot of stocks doing that day. I know Praxair was doing it. I think I talked about that last week. I think you saw a number of these retailers come up, and they were doing it, hitting the 50-day, and then boom, that's rallying back on Nordstrom. I still think these are all weak and probably shorts. Tiffany was a decent short, but notice how it breaks down to the 200-day, gets some volume, and it bounces. But this could roll over again, so I'd watch this rally here. Let's see, Deckers is another one I've been looking at. Same thing. You could have gone short here. It's a nice break through the 200-day moving average, and now you're rallying back up into the 50-day. Maybe it becomes shortable here. So you could take a position, but if the market continues higher, then it may not be the right position to be short the stock, and you want to back away and then rethink it as the market continues either to rally or if it finally does roll over. So you have to synchronize these things with the market. And you can see how when the market's moving with you, excuse me, you're in Fat City, okay? And if it's not, they're just going to push you and squeeze you, and you're not going to be very comfortable while that's going on. But I'm seeing a lot of this action. I don't know if this is triangulating, and you're making a higher low here, and this is just going to continue out here and go higher. But to me, it looks like it just might just want to roll over. So I would be keeping an eye on that in all of these, actually, and look at the weakest ones in the group, because I do think that RTH looks pretty ugly in here. This is a retail holders trust ETF. I kind of keep track of that. Notice how it rallied up right into the 50-day roughly and into prior resistance here, which would have been in this area in here. This is kind of a congestion area in here, and so it rallies right up in there, and the RTH rolls over. So the retail sector is pretty weak right here, as far as I can see. And those are some of my targets that I'm watching, okay? Now, I don't know necessarily if I want to go hog wild. I got some positions out, but nothing's really going on. You go up percent, down percent right now. That's intraday, so we'll just see whether this thing blows apart going to the close. But it doesn't look like it wants to. It looks like they'll try and hold it up today, going into tomorrow's Obama speech. Now, this would set up a classic sort of news-related push in a bear market, where rallies in a bear market are often related to news of some sort. Like we had yesterday, things were resolved when they announced that Germany didn't find issuing Eurobonds to be unconstitutional, so they get the market going today. You'll have, Obama's going to say this, that, and the other thing, and maybe you have a rally on Friday, and it takes you up into here, and you can short into that. So you got to watch how the news affects things as the market bounces, because it will. And most bounces within bear markets are related to news. Let's see. Somebody said here, how do you get individual stocks RS rating, composite rating, and such? Do you use markets? Well, IBD has the composite rating, so I use a number of systems. I use composite ratings that come from High Growth Stock Investor. They have their own ratings and relative strength ratings and EPS ratings. So there are several companies out there that have different ratings. It's not rocket science to create a rating. There's no magic ratings. I think ratings are good in terms of helping you to define stocks that are showing an aggregate of positive characteristics. And I can tell you one thing, I think the IBD composite rating is a great rating to use. And in a bull market, the magic screen is for those of you who use MarketSmith, and if they have these parameters on there, I would imagine they do, because it looks to me like all they did is create a competing product with MarketSmith that competes with Wanda. Sometimes it appears. And sometimes the data on MarketSmith is updated before Wanda, which I think is curious. But if you get a follow-through day and you run a screen, for every stock that has an 85 composite rating or higher, and it's also showing a supply-demand ratio of 90 or higher, you pretty much pick off all the strongest stocks at that point in time. So that's how it works. And that composite rating was designed to overcome some of the deficiencies, say, in the relative strength rating, which in 2003 was really lagging for some leading stocks. So how would you interpret a move that MLM had yesterday? Why would you have to interpret it? It's up below average volume, so it's up, it's pushing it up into its 50-day moving average. Nothing really too tricky there. Gupta, or I'm sorry, who's that? Rohit Gupta. I like that name. There doesn't have to be any news. Sometimes, they're just kind of sold out in the short term, and so they just kind of bump up the upside. So, but I think anything you're targeting on the short side, you watch how it rallies into a moving average. So I want to go through some more of the names, though, that I've been looking at. I think Rovi possibly could be a weaker name. It's coming up in this area. I've been watching this, and you've got this let's go. Actually, I'm using the wrong charts again. You can see I have one chart here over here. This is just for the NASDAQ composite. And you have to specifically put the NASDAQ volume on the chart layout to get it on there. So, whoops. Leave that alone. Okay, so let's come into Rovi here. You can see it got hit 3 days, so it rallied up into this area in here. Didn't quite make it to any moving averages, but sometimes, you know, they won't make it all the way. So that's why I'm saying in some of these cases you can't be testing it. But if you look at the long-term pattern, it's pretty ugly. I don't know if you want to call this a head here. I don't know where the right shoulders are, here or here. But it's kind of an ugly cup and handle that failed. So I would be looking at rallies up in this area for around 50, which being shortable. You know, I was looking at Limited. We looked at that. We looked at Nordstrom. We looked at Praxair. A number of these stocks. Riverbed is another one that's kind of too dead right now. You need to think about shorting. It's far down this pattern. You don't want to hit it up here. Rax, potentially one to be looking at. It's really light volume and it's gapped up today. I don't know if it's going to get up to 37.73, but I figure if you're taking a short position here, that's kind of your upside risk. So that's about 7-8%, I guess, from here. Now, Monsanto, last week, I think this is a good one to go over because last week we alerted you to 2 potential pocket pivots. First being JVA, which was Coffee Holdings, which had a nice, once it hit the pocket pivot right here, it had a nice 10% plus move that you could have traded. It's moving again. This pattern may take some time to fill out, but that one did work in the short term. Monsanto looked like it was going to have a pocket pivot on this day here, and it just did clear the 50-day moving average, but it could not get above it. Volume picked up here, and if you recall, I put out a short sale setup alert on that day and said you could consider shorting it using the high of the day or the 50-day moving average as your stop. And of course, if you did, yesterday we let you know that it did undercut this low, so you might be in a good spot to cover it on a short-term basis here. Now it's rallying back up into the 200-day moving average on weak volume, and maybe it's going to run into it and then roll over. So keep an eye on that too. You know, I think another one to look at, I was looking at earlier, is Agrium, which is coming up into this high again. I guess you could come in here, use that as your stop high this day. But I notice also that Potash is trying to do the same thing. I don't know if these are going to break down. I keep an eye on them, though. The rally's a little suspicious. And look at these choppy, volatile patterns, you know. I also should point out that right now where you're at in the market in terms of being in the chop zone, I'm oriented to trying to build positions for an intermediate term trend at least when I'm long. But when I'm short, I'm very open to day trading or swing trading in 2 or 3 days. So, you know, I will come in and I will short, and I did short Rax here, and then I'll come in and cover it on the move down after 3 or 4 days. Now I'm looking at shorting it again. And when you get into the chop zone, if you get a good sense of the rhythm of the market, you can come in and boom, hit them, break, cover. Boom, hit them, break, cover. And you may maybe do it again. You may eventually get stopped out, but I can do a lot of hit and run type short selling if I know that I'm in the chop zone. Now, if we start to really break down, then that's when you can get more aggressive, and that might coincide with seeing more patterns that look like head and shoulders breaking down. So, you know, speaking of head and shoulders, Sohu is one to keep an eye on. I think this is the weakest of the Chinese internets right now. They're all kind of the same. I mean, if you look at it, you look at CNET kind of doing the same thing, but in a little bit better position. Sohu's, for example, is up right up into the 200-day, whereas CNET is beyond both of them. NetEase also is beyond both of its moving averages. But look at just ugly, choppy and sloppy. And you can see that if you're acclimated to shorting weak rallies, you could be making money on the short term just flipping these over every 2, 3, 4, or sometimes 5 days. But the long-term trend eventually will come into play whenever the market heads down on the next leg down in one of the indexes. And, of course, that's going to occur. I'm going to go to the S&P. That's going to occur when you see us break down through these lows eventually. And, you know, all bear markets are like that. I'm going to just go back. We look at a weekly chart, for example, on the NASDAQ. We'll go back to And here's your top in 2007, and you broke off the peak. So I kind of see us right now. We broke off the peak, and we're in this phase. And this goes on for, 1, 2, 3, 4, 5, 6, 7 weeks before in the 8th week you start to break down in earnest. So we are now probably in about, we've broken down hard off the peak here, and we're like 5 weeks into this. So it could be shorter, it could be longer. You just kind of watch it. But we're in a logical phase where you're going to go through this and then start another leg down. You go back, 2000 is similar to that, but 2008, the top in 2007 is the most recent example we have. You can also see here, when you go break down again, you reach a low, and then you spend several months, in fact, most of 2008, just going sideways. So if you're even trying to short some of this, it's going to drive you nuts. Going long will probably drive you even more nuts. And then you finally break down. This is the time to get short. So a lot of this requires some patience and understanding where you are. Now, I think you are, if we relate to the 2007 top, I think you're in something like this. And so it's going to be either this week or within the next month that you're going to see us break down to new lows. And that's my prognostication. Obviously, it is just speculating, so we'll let the market tell us what to do. All we know for sure right now is the market direction model is on a sell signal, so nothing else to know. So somebody's asking me about, let's look at MCP. Do I like the weekly chart of MCP? Not yet, but if it gets tight in here, it's settling down. This thing had a huge run, nice breakout here. And remember, we caught the pocket pivot coming up through here back then, and that was a nice move. Dr. K capitalized on that, his own account. But you're starting to tighten up, so this is a little bit better. I do think that long-term this stock can go a lot higher, but it's had its first move, and now probably needs to build a long base. But you definitely just want to have it on your watch list, I think. Green Mountain Coffee, the coffees are all acting great. I was showing you JVA. It's trying to base. This is a little bit of a funky pattern. I don't know. Dr. K, what's your take on this one? Get your opinion.
GMCR it is certainly it's part of my group of leading stocks that I'm following, and did have a gap up in late July on good earnings. It continues to impress the market. It got some support right around its 50-day there. So I'm watching and waiting to see how this is going to react relative to the general markets. I would expect it to outperform the markets if the markets can get back on track. But that is a big, big if, because history has shown us, given where we're at right now, and we are in this chop zone, I would lay odds being greater that we're going to retest the lows before we retest the highs.
Yeah. One thing to note about Green Mountain today is you're making a top here, so you're coming back up to this top, so it's like a double top. It's also a very short double bottom, so it's flawed in the sense that it's really not long enough. Also, if you look at it on the weekly chart, here's something I want you guys to keep in mind when you're trying to interpret a double bottom. You'll see a double bottom on a daily chart, but as far as a base goes, only 1 week down on the first part of W. In fact, if you look at this weekly chart of GMCR here, you can't even see a W. I mean, you can define one here, you can see the pattern, but you can't see it on the weekly, and you should be able to. And usually that implies that you're going to see 3 to 4 to 5 weeks on the left side of the W. So if you only have 1 week down, that's not really a proper double bottom. And I would be wary of the fact that right now you're running below average volume. Let's see, my Bloomberg says minus 5% right now. So you're double topping here on light volume trying to break out. So that could fail. So that would be a logical failure point. But, Green Mountain's been a great stock. It's a little bit difficult to play at times. Because it tends, throughout this area, it was all pretty volatile. But nice gap ups that are playable. You could have bought this gap up, never violated the low. Here it did, but just continues to truck higher. And I think some of that's related, JVA acts pretty well too. Interesting stocks to keep an eye on. Maybe JVA will set up and go higher. Maybe it becomes the new Green Mountain. But I don't know, Green Mountain, very obvious name here, could be set up to top. So that's the case with a lot of these, when you're seeing some of these old leaders breaking out. Somebody asked a great question here, and that is, there's so much news out there. Which one do you listen to, and how do you filter news out and find the valid one? Here's my answer to that. You don't need any news. I do think it's helpful to have something like briefing.com. You can enter in a list of the stocks you're watching and the stocks that you own. and it will alert you. It'll give you, sometimes you guys see that pop up on my screen. A little woman's voice says, well, I don't know if it's a little woman, it could be a big woman, but it's a synthesized female voice telling me that that symbol has a news announcement. And so if there's some news that's related to your stock, it'll show up there. But my take on news is this, and please don't tell Fox News this, I don't think you should be watching any news. You can just kind of keep your self in a quiet room. And when we were at O'Neill, the joke was that you're best off, as Bill would say, locking yourself in your room, closing the door, and having people just pass charts and food underneath the door, and not listening to everything. I know.
Sounds like me.
What's that?
That sounds like my existence at O'Neill. I remember when I finally.
Yeah, exactly.
At O'Neill, they had, you know how O'Neill's one of the most sparsely run firms, and I do respect that. Although the carpet's coming apart at the corners, but I was one of the very few people. I don't know how many hundreds of people were there, but I was one of the very few to be given an office. But the running joke was it was like a closet. It's a tiny little thing. I was very happy to have it instead of a cubicle. But when I had the chance to have a TV in my office, I turned it down simply because I like being in what I call the clean room environment. And I find that I have more focus on the pertinent matters and less distractions. And we all know how distracting news can be. Now that said, today I do use certain forms of news to see how the market will react to that news. In other words, if a piece of news is construed overwhelmingly to be positive, and yet the market sells off, that's a clue that the market maybe is weaker than we think, and vice versa.
Right. Somebody asked a good question, I think, and I'll answer this real quick. It says, NASDAQ volume, do you analyze NASDAQ volume the same as you analyze SLV volume? You just mentioned SLV's selling volume is drying up since August, and NASDAQ volume is also drying up since August. It is drying up on the selling side. It also is drying up on the buying side. So you're in a downtrend, so you've come off a peak, and now you're consolidating this move down. So the way you look at this, and I'm using the S&P here, but the NASDAQ's virtually the same thing. So the way you look at this is as a consolidation of the prior move down off the peak. Silver is different in the sense that if you're going to look at the SLV, you're now looking at this pattern in the context of this moving off a low. So really, it's flipped. Okay, so they're not the same thing, because you're running into selling on an uptrend, whereas here, where you're consolidating a move that's trying to trend higher, and in fact, you are following this trend line. Whereas in the S&P on the daily chart or the NASDAQ, you're trying to bounce and rally, and your overall pattern is lower, and you should actually be pulling down as the volume is drying up, not rallying up. That's a wedging rally. So you look at it differently and interpret it differently, because in one case, the market is in a downtrend off of its highs, whereas in the opposite case, silver is in an uptrend off of its lows. Okay? Now let's look at Starbucks. Somebody asking me about that. Starbucks. Well, coffee's king, I guess, right now. So it's rallying on, not the highest volume on the planet, but I wouldn't buy it. I don't know if I'd short it. It's too choppy. Then it's what you're seeing in a lot of stocks. It's sort of chop and slop. It's not all that constructive. That doesn't mean that they might, eventually set up. But we think that the evidence right now tells you that even if you were going to bottom here and start a new bull phase where you break out to new highs, and Obama comes out and surprises everybody by telling us that he's going to institute a 20% flat tax across the board. Hell has freezed over, and Hillary Clinton has switched to a party affiliation of Republicans. So I think all those things could happen tomorrow, and the market would just jack out of here. So, but I don't think you're going to see anything decisive in a lot of areas of the market, the indexes, and potentially leading stocks for a while. So, DBA. Getting back to ETFs, how's DBA? I don't really like it. Agricultural ETF. What's in this thing, Dr. K?
DBA is mostly, it's actually spread around corn, soybeans, sugar, cattle, cocoa, coffee. I mean, it's got a lot of Yeah, it's spread around through all sorts of agricultural products. So it's
So
one
here's
year of the
cotton.
Commodity Research Bureau Index, and
Okay.
I would say that if the world is going to have a recession, then commodities of this sort, this basket of commodities, there's going to be less demand on them, so the price is going to drop. So that's a big if.
Yeah.
Who knows if the world's going to have another recession in the next year, or maybe it's going to get postponed. With all the central banks printing the money at the rate they're doing, maybe they print enough to stave off recession for another year.
So, all I have to say is, how's DBA? It doesn't really thrill us. It's in a base, so it's trying to come up out of there. We prefer to play the
Stick with
precious
gold.
metals. Yeah, and mainly because the recession and all can bring down some of the commodities, food commodities as well. I mean, over the long term, declining fiat currencies will drive the prices of most commodities higher anyway, so we think gold would go with it. But gold also has that extra feature of being an alternative currency itself. Although I suppose you could use corn as an alternative currency. I do know that in Wisconsin, many years ago, centuries ago, a couple centuries, they used to use beaver pelts as money. So, I guess anything can work. But our take is that you want to be long gold and silver. So,
We had a question on well, I guess the intent was to discuss whether Baidu and Google are still leaders. And from looking at Baidu, it's holding up okay. It's getting support at the 200-day. Perhaps it's owned by a lot of institutions, so it looks like it does get support without breaking down. But I wouldn't own this stock. There are stronger stocks even in this challenging environment we're in that I'd rather own than Baidu.
Yeah.
And Google, it's a mess. I wouldn't touch this with a 10-foot pole. It's just all over the map.
not at all. This thing is a mess. In fact, look at the long-term chart. Let's shrink this puppy. Here's the long-term chart. You've got this is a weekly chart, and you see you're in a giant cup with handle where you had a cup with handle that had failed out. It comes straight up off the bottom, right up to resistance, and just blows apart right there. Now it's trying to rally back into the 50-day. This is looking doggy. So we wouldn't be touching it. Now, I'll tell you what I think about Baidu. I think Baidu is still potentially a late-stage base failure, or late-stage failed base. And the reason there is that if we look at this on a weekly chart, okay, this is a sort of a deep cup. And when I've studied a lot of these patterns of leading stocks when they top, one common pattern that you will see is that a stock will have a long run, and you notice how most of these pullbacks are reasonably contained, and then at the top it'll have this big, ugly, deeper cup and a big wide cup, and a lot of times they'll fail off of those. So it did.
Yeah, actually, I would second that with one of the studies I did some years ago was the study of market tops, and it was interesting to see how many former leaders that went up five-fold or even tenfold, 10-baggers, all had that same characteristic at the top where it's almost like they start to break down and they don't know which way to go, and their former prior pattern, which was very nice and constructive, and that constructed pattern might have gone for a year or two or even 3 years, all of a sudden now over a period of a couple months it starts to break down, and that's always a telltale sign, I think. So that became one of my rules to always watch for that. And
Yeah.
Baidu, it looks like it's expressing that kind of action right now.
Yeah, and so a lot of times Dr. K and I will do research and it confirms. In this case, this sort of pattern, where you have a long run, and then finally you'll see a big rounded kind of cup that it tries to break out of, and then it fails. So what's happening here, if you look at this, you break down off the peak, you do bounce off the 200-day once, and then you fail again, you reverse and retrace that whole range from the prior week. The volume picks up, that's 4 weeks ago here. Okay, then you try to rally on lighter volume, but you're bouncing off the 200-day, so that's very logical. You run up into the 50-day, you reverse. This is a 10-week, 50-day moving average, and now you're running back up into it. So this could actually become shortable, especially if you got up to 150. That's potentially the case here, and this could roll over if the general market rolls over. So it could become a short sale target. Google, I'm less certain about. Mainly, I think Google actually has experienced a long-term pop. It's been a leader for a long time. You know, the only revenue stream they have comes from their AdWords and their advertising-related things. They're not really picking up the revenue that Apple has been able to pick up from their user base, or Amazon's been able to pick up from, say, their user base.
Facebook as well is generating quite a bit of revenue. So there's all these other players now involved in the space that are eating away at Google's overall revenue stream.
Right, and even though they have the Droid operating system and that's doing okay, it doesn't appear that Droid tablets are be able to take out the iPod. So, have you heard any news on regulators looking to leverage ETFs and effects on markets? Well, you know, the government, the only thing they're good at is investigating things after the fact. So, do leverage ETFs have an effect on the market? They might, but I don't think in terms of exacerbating intermediate-term trends that's really a factor. What's your take on that, Dr. K?
You know, I don't really pay much attention to it. I'm just focused on the price volume action. That really tells me everything. You know, government action tends to be pretty late to the punch.
Right.
And that said, you know, once in a great while, we will get a piece of legislation that's passed that is important and represents a fundamental change for the market, and that, of course, I pay attention to because I want to see what I think confirmed by price volume action. And if it does confirm, then that's a nice little gift because then you can profit immensely off the change in legislation.
Yeah. Somebody asks, somebody's writing a book and they want to know if we're writing another book or if I'm writing another book with Dr. K. Actually, Dr. K and I we wrote a chapter for a book that just came out, The Wiley Trading Guide, Volume 2, and it's available on Amazon, I think, for pre-order. I think they told us they shipped them. I got a couple of copies here, but I'm not sending them out to anybody.
Yeah, I think they're. I've had some questions. There are links. There are stores on the web that are selling the book now, or at least taking orders. So if you just type in the title, Wiley Trading Guide Volume 2. You'll pull up a whole bunch of links.
Yeah, the other thing we're working on right now is a study guide for the original Trade Like an O'Neill Disciple, where we'll get kind of into more exercises, kind of reinforcing the material. So we're hoping to use some of the technology available in terms of multimedia stuff and being able to, you know, click on things or touch them with your finger and open up charts that move in 4D, you know, stuff like that. Did I say 4D? Whoa, that'll get a lot of questions coming in. But yeah, we're going to be writing about the markets. It's fun. And I'll just let you guys know, when I was a kid in my teens, I was editor of my high school paper, and I won tons of writing awards. And I think Dr. Case won some awards for writing as well when he was younger. But I fancied myself a novelist or a journalist, you know, in the order of John Steinbeck, say, who wrote novels and also wrote articles for various journals and traveled the world and, you know, talked about it. So I fancied myself a writer at some young age in my life, and I guess you come full circle and you write. Writing is fun. I enjoy it, so I'll keep writing about what I love, which is the markets. And I think Dr. K feels the same way.
Yeah, it's interesting.
Until it isn't.
I was going to say that in grad school, that was the one thing that almost derailed me. Not the stock market, but writing. I got so involved in writing after midnight, usually in the small hours of the morning, and writing sketch comedies. And I felt that I finally made it, so to speak, when I got a call back from the head writer at the David Letterman show and said that he'd never seen anything like my material and wanted me to write monologue jokes for David. And I thought, this is amazing. And I was in the lab. I like just had removed my gloves, you know, from the hood and everything. So that was a very much a moment of truth for me. And then I just love being able to write and express myself, not just in the markets, but also I write a fair bit of fiction as well. And so there's a few books I believe that are hopefully going to be published down the road.
Yeah, and we're somewhere in the works right now. So all I have to say is we like writing. It's fun, and we especially like writing and talking about what we're passionate about, which is the stock market. So, and we will stop when it's no longer fun. So, Let's see, COG. Some people asking about COG, Capital August. What do I think of these patterns? It's trying to break out, so I guess if you want to buy it and use a stop, you can do it. But am I willing to go long anything in this market? Not really. Jazz Pharmaceuticals. Here's what I don't really like, and this is where you're seeing some of these. Look at this sort of jagged, volatile action. That's breaking out. So it's not really breaking out of a constructive pattern. So I think the odds of success are lower. Now, I don't know if that means it might work. Maybe it does. But that sort of thing bothers me. Just so you know, Scott. New Skin, yeah, same thing. It's very volatile. So I don't like this company either. I think they're just a bunch of baloney. I hope there's nobody out there who does sales for them. But it's a pyramid marketing thing. You try to get as many people as you can. It's like Amway used to be. And I think a lot of it's just hyped stuff, and they get people to buy it.
In this area, you have to be really careful. I mean, this is a multi-level marketing campaign, and there's so many of these types of beautification products on the market, and I would say that 99.9% of them are probably not worth the money. I mean,
right, and look at the pattern
a person's
here.
better off having a good diet, getting good sleep, getting good exercise.
Yeah.
And these skin methods, I suppose, well, they're kind of like a temporary. They're temporary, So if you want to look the best you can, maybe some of these products are worthwhile just for the short term. But I always say, if you have the time, and not just for the sake of your own personal appearance, but also for the way you feel and the way you think.
All right. No health advice, Dr. K. Let's keep it to the market.
Well, our second book's going to include some of this. So, optimization of mind and body, basically.
Our attorney said, though, don't talk about any supplements because someone might take something and die and then they'll want to sue you. But look, let's just get back to the base of NUS. Look at this base on a weekly basis. This thing is kind of nutty. It's just back and forth, very choppy in here. I don't really like that. And it tries to break out, kind of does something else, breaking out again. I don't know. Maybe it goes higher, maybe it doesn't, but I don't think I need to buy it. So, just I'll answer this question for like the 100th time, but we do get a lot. Have we ever done a study of inverse pocket pivots for shorts? No, you don't. I don't think you really need to because shorts don't percolate the same way necessarily that pocket pivots do. Pocket pivots are things you see within a base stock setting up and presenting buy points within a base, whereas this idea of pocket pivots, and I know what you're talking about. I probably could pull one out of my ears here. Let's see. Let's go.
Yeah, I've never seen ample evidence or enough evidence to make inverse pocket pivots worthwhile. Simply because when stocks sell off, they tend to do so in a volatile manner compared to stocks that are just about to launch, which usually get very tight and constructive in their pattern, and then have a pocket pivot after that level of constructive.
Yeah. So let's use this for example. Okay, here's is this a pocket pivot inverse right here on this day? Maybe, and in what conditions? So we really haven't studied. Is this a pocket pivot? You have the highest volume, or right here you have the highest volume over 10 days, and it breaks down. I don't know. I think you can just short stocks on the basis of the price volume action because there aren't really these defined bases, or where you want to see tightness, in as you would on the long side. Okay, when you're seeing pocket pivots. So it's not anything that we study. I don't even know if you really can necessarily study it because when the market breaks down, everything breaks down. But when the market's in the bull market, there are definitely big leading stocks that will show certain signs of constructive behavior. Somebody asked about Lulu, and they're taking what I said earlier, and I think you're missing one part of what I said earlier about if you take any stock, when you have a follow-through day, okay, in the market. In other words, the market's telling you it's starting a new or a buy signal in the market direction model, for example, and you look for new leaders to buy. If you run a screen on that day of the follow-through, when the market's turning from bearish to bullish, okay, and you want to find the initial leaders powering out of there, that screen, composite rating of 85 or higher, or you could use 90 or higher if you really want to bring it down, and a supply-demand ratio of 90. Use 90 or 95, but it will bring you a very tiny amount. If you go back and test that you actually find that that screen will find the initial big leaders right away. So that's a good screen. But you're in a different context now. So Lulu has a supply demand of 90 and a composite rating, I think, of what, 89? Is that right? 98. So, you know, it's got those, but you don't have a follow-through day right now. You're kind of in a downtrend. So I'm not sure if this is really something you want to be buying. It probably tells you, though, that right now it is a stronger stock, and you can see it is. So, but it could be also morphing into a late-stage failed base. So, I mean, here's some of the things I'm looking at right now. If you look at Lulu, you can see the prior bases were pretty nice, but now let's see you get this real jagged, bizarre retracement of the weekly ranges back and forth. So it's really not constructive in terms of the base. So, but let's say we got a big follow-through day and the market direction model went to a buy signal. If Lulu showed up on your screen, that would probably be one of your first buy candidates. And you can see that, in fact, it is in a reasonable position on the daily chart. But I think the weekly chart argues for the fact that it's got some problems that it has to work through, and so this obviously has its implications for the general market. So Letterman could use some help now, says Ray. So Dr. K. Okay, I'm going to go. We're actually past. It's 10:52. We've been going for an hour.
One quick one on GDX about its recent breakout.
Oh, the miners.
Breakout. Yeah, the miners. You know, my view is that gold. I'm bullish on gold, and therefore I am bullish on the miners in a long-term sense. But the miners are not as clean as playing the GLD or DGP ETF. So I prefer playing pure gold rather than the miners. And the miners can also get derailed off various pieces of legislation, which can be upsetting to them.
Yeah.
But
I'm
bullish. It looks good. I mean, it had a tentative breakout, but then keep in mind that gold is also, you know, in a bit of a choppy phase after having a bit of a mini blow off.
And if the metals go higher, they will drag the miners up with them. But just remember, if you're in a bear market in stocks, miners are stocks, and so they'll tend to get dragged down with them. I'm just going to run through some names that people are asking just to wrap up here. And people are asking us about IBM. It looks kind of ugly, so I don't know. I went shorted. It's not really high enough to show. You could have shorted it up here, but it is a late-stage failure, so you'd need to see a rally into an area of potential resistance to hit it. ARCO, we talked about this last week. Their largest franchisor, McDonald's, and they're in Latin America. It's the volatile stock. I'm not a buyer. Let's see. How about some other ones here? What do we got? Can you explain a little further the concept of supply-demand and a score of 90 or higher? You have to have MarketSmith to understand it, and then you can email them, and they'll tell you all about their supply-demand ratio and the composite rating. But I'm just saying, if you use MarketSmith, that's a good screen. Alexion, I don't like this V-shaped stuff, but, you know, I'm not going to buy it. Questcore, we've looked at that one in the past. It's hanging in there okay. This looks a little better. But again, it's one of these bases that's got this wide, loose action, and you see this in so many leaders that it leads me to believe that we're not likely to start a new upplay. So I think in terms of leadership, I'm not really looking at too many things. There are some things that maybe if they got tighter, they could be setting up okay. You know, Herbalife, I don't know. It kind of reminds me of Cans in some ways. You know, it's got that same kind of formation, so you know they're all kind of iffy. Doesn't really thrill me. There's LVS is short. You know, there are weaker stocks, and it doesn't want to break down. So for now, it's holding above its 200-day, its 50-day. It's not really in play yet for me, so it would have to break down again. It is pretty wide and loose. You see a lot of flopping around in this pattern. So my guess is eventually it'll break down, but I don't really see it in that position just yet. So it might be getting there. But you got this weird gap up. I don't think the volume's all that heavy. And that's what you're seeing in a lot of stocks today. Well, gold and silver, just to do a recap. So I'm just going to wrap up here. Sorry I can't get to all the questions. You know, if you do have questions, save them for next week. Email us in advance of the next webinar. We might have another one this week for all we know. But if you email us in advance, we'll compile those and be able to answer them. But remember, we cannot and we will not provide individual opinions on stocks to, you know, on a personal basis. We do it in a group format. What we put out to the group. It would be unethical to provide views on stocks or anything else we're talking about that are only to one person who decides they're going to email us. And we're not stockbrokers either. When I was a stockbroker, you have clients, dumb clients, calling you all the time to, what do you think of this stock? What do you think of that stock? What do you think of this stock? And we don't do that. We can't. Think about it. If you got subscribers well into the quadruple digits, you don't have time to provide individual advice. We got to trade our own accounts too, guys. So cut us a little break there. Can you forgive the choppiness in the stocks? I don't think so. Not now. I mean, if you want to and buy it, start plowing into the market, go ahead, see where it gets you. But it's not what I want to see. So the market bouncing right now. We think you're in the chop zone. We're still using the 2600 level or the high of that day on the Nasdaq Composite as your stop. Okay. If you want to use a tighter stop, I don't know, maybe filling the gap or getting through this gap or something. If you want to get tricky, go for it. But that's what we're operating on right now. And if we go to a cash signal, which could happen, I think you just operate on that basis, and you'll be okay. You may not keep all your profits that you've made in a couple of days, but that's not your objective. Your objective is to play an intermediate-term trend in the next leg down in a potential bear market. So, some of these. I mean, these are good questions. I think asking, for example, deeper handles seemed okay in the context of a bear market. Yeah, but those deeper handles took some time to form. If you go back and you look at AOL's pattern, it was making higher lows ahead of the market, but the market had already come down 30-something%, and you had 3 waves down in the market. And so that was a very volatile 3-month bear market where you came down over 30%, okay? Right now you're down 15% or so, maybe 14% on the indexes. It's not the same thing yet. So, if you want to say that it is and you can just go and buy things on that basis, go ahead. I'm not doing it myself. I don't think I have to. Maybe they don't have supply-demand ratio. I call them up and ask them. Tell them to put it on MarketSmith. You guys have a macro view of petroleum? No. Probably weak economy, it goes down, weak dollar, it goes up. But either way, I don't know. And then finally with gold and silver, for those of you who came late, we just think they're okay. They're just in consolidations, and they're going to have to probably take a little time working their way higher. So that's really what we're looking at now. So any other questions, save them for next time. And I just want to thank everyone for listening today. You can see the support on silver here off this trend line. So they look okay. So we're not selling them. All right. Thanks, everybody, and we'll catch you next time.
So long, everybody.